Why cryptocurrency won't see another bull market. It's completely changed. Now, the cryptocurrency market has been wiped out since the Federal Reserve announced they would start raising rates last November 2021. And it set off a domino effect leading to a crumbling of cryptocurrency players like Terra Luna, Celsius, BlockFi, and now, of course, FTX, wiping out tens of billions of dollars and millions of people's wealth. And while the crypto hopeful have seen these types of massive drawdowns before, and some are either hodling through or waiting to re-enter for the next crypto bull run, I believe we might have seen the last one because the markets have changed. Now, FTX was the final catalyst. And so in this video, I'm going to explain why I think things are now different and how there may not be another crypto bull run, but why I think there will be another and even bigger run for Bitcoin in the future. I'm going to explain the fundamental drivers of the markets, how they got so overheated, why they won't again, what I think happens with regulators from here, how the crypto market responds to this, what to expect next, and of course, I'm going to answer all the angry messages I got regarding this post on Twitter. So let's go. All right, welcome back. If you're new to this channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you've learned is wrong, and if you don't really understand what's going on, it's hard to see what's really at play here. Now, I'm talking about the cryptocurrency market and why I think there may not be another bull run coming. And I know this got a lot of hate. I posted on Twitter. I got almost 1,000 comments of people telling me I don't know what I'm talking about. So I'm going to break this down. I got all the receipts to show you. And I do want to just say real quickly, I spent 2016 to 2019, 4 years writing a cryptocurrency research newsletter. I personally researched and published over 1,000 pages of research on all the crypto projects out there. I've been around for a while. I've been to every conference. I've done the research. So I know a couple things. I'm not an expert, but I know a couple things. All right. FTX, of course, FTX is the big catalyst. It's the big elephant in the room. It's, the biggest cryptocurrency exchange, $32 billion valuation, tens of billions of dollars vanished. But more importantly, FTX was driving. I've already made a couple videos. You can see here, I've done 2 videos breaking down FTX. We'll link them down below if you want to watch them later. But I talked about how they were basically creating money out of thin air and using this money to go push regulations. And now, with them blowing up, all those regulations they were trying to get through, here they come. It's the catalyst, okay? So go watch those previous videos. But in the one video, I said this deep state PSYOP is basically they were using all of these stolen funds or counterfeit funds, as I call them, to push and create massive regulations, all right? But now that this is blown up, it's put all eyes on this. There's a massive push from retail, from institutional, from regulators to bring more regulations. And so we know we can expect more regulations. Now, I put this out on Twitter where I said that I don't think the crypto market fully understands what happens when the SEC makes 99% of tokens securities. This is why I believe we have not seen the last crypto bull market. And like I said, this got over almost 1,000 comments. And I can't address every single comment, so I've got a video here. By the way, if you're not following me on Twitter, you should. It's just the #1 Mark Moss. Let's go ahead and put that up on the screen for them. All right, so let's break this down. Now, I want to just start this conversation because I got accused of this in the thread that I like regulations and I want regulations to go shut down crypto. I don't like that, all right? If you guys watch my videos, you know that's not the case. I don't like them. I don't want regulations. I don't want the government. I am for less government and more freedom. I don't think I need the government to protect me. I don't think I need the government to tell me what to do with my money. If I want to gamble it, if I want to buy lottery tickets, I want to buy crypto, it's my money. I should be able to do what I want, all right? So that being said, as a matter of fact, I was at the Bitcoin conference 2022. I was speaking with Mr. Wonderful, Kevin O'Leary, and you can hear exactly what I told him. Let's go ahead and play that clip.
Yeah, I mean, I love the industry's reaction to it. As we talked about yesterday here on the news desk, as an American-born citizen and believing that we're free, we don't ask for permission. Everything's free. I mean, everything's legal until proven otherwise. So we're not asking for permission. I do think that, having some clarity around some of these regulations will help these institutions move in.
All right, so you heard it directly out of my mouth talking to Kevin O'Leary. Of course, I was responding to him because he's a Canadian and he was asking for more regulations. And I'm like, hey, I'm an American. We don't need regulations. We don't ask for permission. We're born free. Okay, so I don't like them, all right? I know people want them for more clarity, but it's not about what I want or the way I think the world is. It's about the way the world is. And the fact is we do have a SEC in the United States, Securities Exchange Commission, and we do have a CFTC, all right? And they do have roles, and their role is to regulate financial markets, okay? So I don't want it. I'm not saying I want it. I'm not saying I want them to push it or shut it down, but we do have them. Now, their job is to protect consumers. That's their job. So they either need to do their job or they should just shut down. That's my point. I think Gary Gensler, this SEC, looks completely horrible. He's going after Kim Kardashian and finding her $1.25 million for posting on Instagram, but yet he lets FTX go steal $30 billion. So I think SEC is a complete catastrophe, and they should just shut down. I just don't think that's going to be the case. All right, now that that's clear, let's go ahead and jump into this. So we have two regulatory bodies, really. We have the SEC and the CFTC. Yes, there's plenty more, but these are the two of the main ones. And so the SEC regulates securities, and the CFTC regulates commodities. All right. Now you hear a lot about cryptocurrencies. Are they securities or commodities? Which regulatory body will govern this? All right. So just real quickly, how we break this down. Securities are things like stocks and bonds. Right? Equities. So when a company goes public, like Tesla, Google, Facebook, Apple, etc., they issue stocks and they issue bonds. All right, and those are typically investments, and I expect returns on those things. I buy them, I put money into Apple or Google stock, and I hope that I can sell it for more in the later, and I get a return on that investment. Now, how do we know what a security is? Well, there's a lot of ways, but there's four main ways, and it was in this court case, the SEC versus Howey, and so it's something called the Howey test. Now, again, I'm not a securities exchange attorney, so consult your own attorney here. But we can just see that in this Howey test, there's 4 points that basically tell us if it's a security. So 1, is there an investment of money? So did I buy Apple stock? Did I buy crypto token? I put money out. Check. 2, in a common enterprise. So is there like some sort of a company or a committee or a steering community or something like that that governs that? Okay, check. 3, with the expectation of profit. Now, if you Google, go onto a search engine and just put like, altcoins or cryptocurrencies, it's all about investment. So people buy them because they hope they're worth more in the future. And then 4, to be derived from the efforts of others. So you're buying it, Tesla stock, Apple stock, and there's a company that you're hoping is making that company stock more valuable, or you're buying a cryptocurrency that you're hoping is going to build out this crypto platform that will have some use at some point. So this is the Howey test. Again, there's definitely a lot more in there, but that is the key pieces here. So when I look at a security, that is the definition. Now, commodities are different. So commodities are typically not stocks or bonds, they're metals, grains, oils. And the thing that's different about those is the extraction or the production process. And so if I'm going to get gold out of the ground or oil out of the ground or grain, so I can go buy a piece of land and I can mine for gold, I can buy land, I can drill for oil, I could buy land and I could grow wheat. Now it doesn't matter where in the world I do this, wheat is wheat, gold is gold, oil is oil. There's no company that makes the oil, there's no central issuer that issued the oil. So anybody can go get this land, they can drill, and they can get those things. And no matter where you get it, it's fungible. Oil's oil, wheat's wheat, gold's gold, all right? There's no common issuer there, unlike a security which has a company, Google, Apple, Facebook, Netflix, etc. All right? And like I said, it's interchangeable, where gold is gold, but over here, Apple is not Netflix, and Netflix is not Facebook, etc. All right? Now, when we look at that definition and we look at it in cryptocurrencies, what we can see that with cryptocurrencies, we have Ethereum, Binance, Polkadot, Cardano, Solana, etc. And what we can see is that in their initial token allocation, so they were ICOs or IDOs or whatever they want to call them these days, it's all basically the same thing. And what we can see here is that with Ethereum, about 20% of the tokens, so first of all, it was a company, They don't call it a company, they call it a foundation, whatever they want to call it, but it's a common issuer, all right? So a common issuer, and they release tokens, and they issued these tokens. Binance, we can see 50%, Cardano right here. Solana, about half the tokens were kept by the insiders, so they control that. We have Tron, EOS, Cosmos, Tezos, basically all of them. Bitcoin is different, where there is no issuer. Anybody in the world can go get a computer, you can hook it up, and you can mine more Bitcoin, but there's no company, there's no steering committee, there's no CEO, there's no board of directors, there's no marketing department, there's none of that. It's sort of like oil, wheat, anyone can go buy it and can get it out of the ground. Unlike every other cryptocurrency that had tokens that were issued. Now, I believe there's 3 or 4 other cryptocurrencies that don't have an issuer, or what we call a pre-mine, and I believe that's Monero and let's see, Ravencoin, I forget. There's like 2 or 3 others, but that's not really important for what we're talking about here. All right, so that's the big definition. Now, before Gary Gensler was the head of the SEC, we had Jay Clayton. He was the head of the SEC, and let's hear what he had to say about Bitcoin. Roll that clip.
Cryptocurrencies. These are replacements for sovereign currencies, replace the dollar, the yen, the euro with Bitcoin. That type of currency is not a security.
Okay, so before Gary Gensler, we had Jay Clayton said that Bitcoin is a commodity. Okay, Bitcoin's a commodity. But what about all the other cryptocurrencies? Well, he went on to tell us what he thought about that. And let's go hear directly from him.
Let me turn to what's a security. A token, a digital asset, where I give you my money and you go off and make a venture. You have some company you want to start or something you want, and in return for me giving you my money, you say, you know what, I'm going to give you a return. Or you can get a return in the secondary market by selling your token to somebody. That is a security, and we regulate that.
Okay, so there you have it. Directly from the old head of the SEC, Bitcoin is a commodity, cryptocurrency is most likely a security. Now, stick around to the end because we're going to hear directly from the current head of the SEC, Gary Gensler. We'll pull up some stuff from him in a minute. Now, I want to say real quick, I can already hear the comments piling up. Mark, you're an idiot. Mark, you don't know what you're talking about. Watch till the end of the video because I'm probably going to answer your question before you leave those comments. And while you're at it, you can hit that like button and subscribe because I'm putting a lot of good info out here for you. Okay, now let's take a look at this. Altcoins versus the alternative. And if you really want to break it down to its most basic, remember we have to break things down to like a first principles level. We understand that altcoins, they're really not unique, okay? It's some cutting edge technology, but themselves, they're really not that unique. What they're doing is they're preying on regulatory arbitrage. And what do I mean by that? Well, the arbitrage is the difference they can make on the regulation. So in order to issue a security, if you're a software company or a payments company like a PayPal, or you're a software company like a Google, you have to go through this long security process, and it costs lots of money. And in order for me to be able to issue those securities or those stock certificates, those equities to the market. But what these tokens are doing is they're bypassing all of that. They're making the difference, the arbitrage on those regulations and bypassing that. And really the intent is to evade security laws. That's what they're really trying to do. All right. Basically, if we want to boil it down, a token, a coin, a crypto coin, a token, whatever you want to call it, is basically the same as a share of stock. They work the same way. The difference is that securities, a stock, takes a lot of money to do it. It takes a lot of time, and you need lawyers. You need lawyers, you need a lot of time, you have to do lots of disclosure, we'll talk about that, lots of money. Whereas to issue a token, all you kind of need is a developer that you hire from overseas and a really slick marketing team. And so they are able to bypass this. Now, this isn't just me saying it, all right? Let's hear directly from case law, all right? So what we can see here is just, I believe in the last month or two, the SEC sued a cryptocurrency project called Library. Now, because what you're saying here is, I can already hear the comments, you're saying, but Mark, you don't understand the difference with altcoins versus securities because altcoins have utility. And because there's utility, then they're not securities. They're commodities. Okay, that's a good argument, and it's not for me to decide, all right? It's up for the attorneys and the SEC to figure this out. But we also have something called case law or precedents. And so what we can see is that that argument that because the tokens have utility, they're not really securities, it didn't really stand up in court. And so what we can see here is that crypto startup library violated securities laws by selling its native tokens without registering with the US Securities and Exchange Commission. Just like Ethereum and Cardano and all the other Solana and all the other coins I showed you. They sold their tokens. There was a pre-mine. They sold the tokens and they didn't register with the US Securities and Exchange Commission. Now, the SEC sued Library, this was March of 21, the ruling just came in the last couple months, alleging that the LBC tokens were securities and that the startup had violated security laws by selling them without registering. Okay, same thing I said. But here's the argument. Library pushed back. They said, wait a minute. They claimed that the LBC tokens were not securities. Look, you said that they're securities, but they're not. And the reason why they're not is because the Library protocol is a blockchain-based file sharing network. They argued there's utility. They argued that it's a protocol that allows people to share files and that you need the token in order to use the protocol. So thereby, it has utility. It's not a security. Well, the federal judge, Paul Barbadoa, he ruled that, quote, no reasonable trier of fact could reject the SEC's contention that Library offered LBC as a security. There you have it. So it's not a security, it's a commodity. And the judge said, no, there's no reasonable trier of fact that would ever come to that conclusion, and it's a security. All right, now what does that mean for the rest of crypto? Now again, I'm not an attorney, so you can go consult your own. But we do know is that case law sets precedent. And what we can see here is the founder of Library, Jeremy Kauffman, has long maintained that the outcome of the case could have sweeping implications for the wider crypto industry. The facts in Library's case would, quote, basically apply to every company in the crypto industry. So the laws, the rules, the ruling on this case basically applies to the entire crypto industry. He says here, under the SEC versus Library standard, almost every cryptocurrency, including Ethereum and Dogecoin, are securities. Okay? So case law sets precedent, and that's exactly what happened. Now, we do have another case law that's being tried here with Ripple and XRP. That's probably going to have a big precedence. That'll probably come out sometime next year. We'll see. Now, the other one is that people say, but Mark, what about DAOs? DAOs are decentralized autonomous organizations. They're not a common enterprise. They're not a steering committee. They're not a company, right? Well, it says right here that tokens, DAO tokens are like shares, it says. Tokens bought by people have functions that are like shares of stock. It says governance tokens work in the same ways preferred stocks work. So whoever has the most stock gets a vote. Whoever has the most tokens on a DAO gets the most votes. It's basically the same thing. You can call it whatever you want, but it's basically the same thing. All right, now one reason why this has gone so big, but it's also the reason why I'm making the case that I believe the crypto bull run is done. All right, so these is tied together. This is what most people don't understand, the 1,000 comments I had on that Twitter post. This is why it's done, because VCs love this model of tokens. All right, now stay for the end to figure out what's going to change about this. But VCs love this, and they don't just love it, it's what's driven this entire model. So what do I mean? Well, let's hear directly from one of the biggest venture capitalists in the space so you can hear it directly from his mouth. Let's go ahead and play that clip.
Sachs, I got to say, I think your AUM is positively correlated with the bags under your eyes.
If you mean it's getting bigger, you're correct.
I mean,
Yes, they're heavy.
good Lord.
They're heavy, dragging you down.
That's where you're hiding all that Solana in your fucking under your eyes. Jesus.
You better clear that Solana position. What's your lockup? 24 months?
Fuck no, he's trying to sell it to me on text message.
Yeah, of course he is.
We're negotiating discounts.
I just had the founder on
Hey,
the
you're
pod.
fucking the whole thing up.
Bro, you don't
Ponzi
think
scheme?
I'm hodling.
you think I buy
You're not
hundreds of
hodling, you're
millions of
clearing.
dollars of anything without a discount? Everything is a discount.
Everything's discounted. You want to clear that position in an LLC?
Are you saying I got $1 billion of Solana?
No, bro, I'm saying I have one, but I bought it at a discount.
But you're holding, correct?
Ish.
Yes. Okay. Yeah, me too.
Okay, so there you have Chamath joking around with David Sachs joking about how they got their tokens at a massive discount and they're just going to dump them onto unsuspecting retail. He's got $1 billion worth of tokens that he, of course, always buys at a discount. But you're holding, right? Well, ish. I kind of dumped most of them on retail. So what happens is venture capitalists love this because here's the way a typical venture capital works. So you start up a fund, which takes a lot of money, a lot of regulatory paperwork to deal with, and then you have to raise investor money. Now you have this venture capital fund. Then you go allocate that money into probably 10 or 15 different projects, and you hope that a couple of them might hit big. You know that most of them won't. But here's the big thing is that when you put that money in, typically that venture capital fund locks up that money for like 7 to 10 years. So I put my money in and I probably don't get any money back for 7 to 10 years, which is painful unless there's a liquidity event. So if I invested into Uber in the early days, I have to wait until Uber either goes public or gets bought. If neither of those options happen, I may not get my money back. That's the way venture capital works. But they love this model because they get instant liquidity. So what that means is investors, venture capitalists like Chamath, he invests in Solana, they give him tokens at a discount. I don't know what he bought them at, let's call it 5 cents, and he's able to turn around and sell them for 25 cents on the market. He has instant liquidity. Who wouldn't want to invest $100 million and be able to 5 or 10x it almost instantly instead of having to wait 7 to 10 years? Maybe it works, maybe it doesn't. Of course they like this model, which is why they've poured in hundreds of billions of dollars. We can see this right here. VC's poured in $41 billion into crypto in the past 18 months. Like this, like a stock machine. You got Bored Apes and JPEGs. It wasn't just 40 million. Sequoia Capital took a $200 million bath on FTX. And the other reason why the venture capitalists love this and really drove this model was because not only were they able to get instant liquidity, make hundreds of millions of dollars on their money right away, then they used that money to build up the hype machine. So everybody hears about this life-changing, world-altering protocol. Everybody's hearing about it. It's all over the media. It's all over advertising. Why? Because they're dumping all kinds of money. So you hear all these stories and you get hyped up. How do we know that? We can see right here that the crypto winter is hurting Google's ad empire. They've lost over 6% of their revenue to crypto. So the venture capitalists who love this were buying these tokens, dumping them on retail, using this money to build all this hype. So you think it's this casino where everyone's getting rich, but really it's guys like Chamath laughing about how much money he's making on your back. All right, so now that you understand how the crypto market worked up until now, let's look at what happens. What happens if the SEC comes and says they're all securities? What happens then? All right. Well, a lot of people are like, oh, no big deal, Mark. I heard it all. Right? I had 1,000 comments on that Twitter post. I heard it all. No big deal. Then they'll just pay a fine and they'll file. They'll go overseas. They'll do all these things. I'm going to break those down. But crypto, they're just going to pay the fine and they're going to file. They'll become a security. No big deal, right? Not really. Okay. First of all, the fine could be substantial. Second of all, the fine could be substantial and force them to shut down. It could be substantial and allow them to file, but then what happens? Well, it could take years for that to happen, and it costs a lot of money, especially for a company that's already so far developed. They're going to have to spend a lot of money, and they're going to have to do full disclosures. All right, this is the sticking point. So we can see right here, here's Coinbase Global. They become a publicly traded company, and they had to file all types of disclosures: who the founders were, who the different token holders were, what type of insider selling might have happened, what insiders sold to each other to retain interest so they retain controls, who has control over it, what the different interests are, how they're connected, what potential risks they have. Imagine if Ethereum had to go through this process. Imagine if Ethereum had to pay the fine, but then they had to file for public. So what is the role between Vitalik Buterin and Joseph Lubin and the Ethereum Foundation and Consensus and Infura? How many tokens do they hold collectively? How have they sold tokens between themselves? Who were the insiders that got the tokens when they did the original pre-mine in the first place? What are the risks that are involved with them doing this now, this merge and this sharding and all that? Imagine if they had to do that. I don't think they could. I don't think they would. And if they did, and you got all that information, all the disclosures, most people would probably run for the exits. That is what happens if. Now, this is not just, again, my speculation. I like to bring you the receipts. This is right here from Etherscan. We can see Ethereum total supply, we can see the Genesis block plus the crowd cell, 72 million tokens that were pre-mined by them, about 70% of the supply of Ethereum that they're going to have to answer for. And I think a lot of people wouldn't be happy finding out what the reality is. All right, now the big thing, like I said, this not that big, not that different. Altcoins versus tech companies. So imagine if all these altcoins, 20,000 of them, were forced to be a regular company and go through the process and create a security. If altcoins were forced to compete with the companies they're trying to replace, payment companies, software companies, gaming companies, if they actually had to compete with those, then you as a consumer would have a choice and you'd look at all the disclosures and all the information, all the risk, and you'd say, should I buy XYZ coin, crypto coin, or should I buy PayPal instead? Should I buy XYZ or Apple or Google? And if you had the ability to get all the information and look at it and compare it and choose, you may not be choosing XYZ coin. All right, now, why am I saying that there may not be another crypto bull run? Well, hopefully you've understood what happens here, but here's the key piece. You have to understand how this industry grew so big and how it flourished, because venture capitalists could bring in hundreds of billions of dollars, could instantly 5, 10, 20x their money, dump it on unsuspecting poor retail people like you being manipulated by media that they're buying. And so this giant scam blew up so they could dump money on you. Now there's a saying that if you're playing a game of poker and you don't know who the patsy is, that patsy is you. And so most people don't understand this is how it worked. I've shown you proof. Do your own due diligence. All right. Now, when I put this post on Twitter, like I said, I had 1,000 comments telling me, Mark, you're an idiot. You don't know what you're talking about. They said the SEC, even if they do it and pass regulations, they can't stop the progress. They can't stop the progress. I would say true. They can't stop innovation. Humans are always going to innovate. There's always going to be innovation. But what we do know is that the regulations are going to come down fast and they're going to come down furious. Right here, how SEC regs will change cryptocurrency markets. This is November 17th. The SEC is leading the push to subject cryptocurrency markets to the full spectrum of financial regulations. The full spectrum. Gary Gensler said the top 5 exchanges accounting for 99% of cryptocurrency trading, quote, likely are trading securities. 99% of all the volume are likely trading securities and should have to register with the SEC. Now, if the exchange has to register with the SEC, then they can only allow tokens that are also registered as securities. You see what's going to happen here? The SEC announced it would increase the staff of its cyber unit from 30 to 50, almost doubling the size of their staff, and rename it the Crypto Assets and Cyber Unit. The SEC's enforcement push will fundamentally change how cryptocurrency markets work. Fundamentally change how they work. This is what people aren't understanding. They're going to fundamentally change how it works. We can see the announcement from the SEC right here. Nearly double size of enforcement's Crypto Assets and Cyber Unit. They are coming for you. And it's not just the United States. So people said, Mark, they can't stop progress. I agree. They're not going to stop human ingenuity. They're not going to stop inventions. We're still going to be innovating. I don't doubt that. We have lots of innovation today. It just happens in the venture stage. So there's already a path for that. They don't need to release a token that can be dumped on your head, okay? So they can't stop progress, I agree. Then people say, but Mark, you don't understand. If the US regulates it, it'll just go overseas. Okay, there's some truth to that as well. And so because the US didn't give proper guidance, they said, well, FTX went to the Bahamas. So it's gonna push it overseas. Well, it's not just the US. As a matter of fact, most of the developed world has similar regulations. Here is FINRA, targets crypto communications after FTX collapse. FINRA is still a US regulatory body. Here we have the Treasury. All guns are blazing. Treasury pledges cryptocurrency regulation. It's not just the United States. After FTX, tougher crypto rules needed after the collapse, says Bank of England. We got Bank of England. We got here, we have now Congress, the Treasury, FINRA, the Bank of England. Everybody is coming for cryptocurrency. And so, will it go overseas? Sure. It can go overseas to some small little jurisdictions that don't have these regulations. But did you understand how this worked? with US-based venture capitalists putting up the money so they could dump the tokens on you and then use some of that money for media push. But if US regulations prevent the selling to US people, that means US venture capital money doesn't go blow up the space. So will it still continue? Yes. Will they stop it? No, absolutely not. But you won't have this crazy, incredible bull run where you could close your eyes and just throw your dart at the board and get a crypto project to blow up, because no US VC money. Now, I'm saying no crypto bull market, crypto, but I am bullish for what happens with Bitcoin. So all these crypto assets are like a DDoS attack on Bitcoin. So Bitcoin should be working like other assets, supply and demand. There's a very limited supply, and if there's a lot of demand, the price goes up. The problem, when there was 1,000 cryptocurrencies, they pulled some of the market cap away from Bitcoin. And there was 2,000, and there was 5,000, and there was 20,000, and then there was 20,000 other choices dragging your interest, your attention, and your dollars away from Bitcoin. If most of that disappears, what happens? Well, all the interest, all the attention comes back to Bitcoin. And so I believe this will be very bearish for crypto, no bull market for crypto, but it will be extremely bullish for Bitcoin. Now we can see the new head of the SEC, Gary Gensler. He says right here, reiterating what the previous head, Clayton, said. Gary Gensler reiterates, Bitcoin alone, let me read that again, Bitcoin alone is a commodity. That's what he said, Bitcoin alone. The government stamp of approval seems to separate Bitcoin from crypto. So when you hear us say, hey, I'm talking about Bitcoin, not crypto, this is why. It seems to separate Bitcoin from crypto. Bitcoin alone is a commodity. Bitcoin alone had no central issuer. Bitcoin alone has no company. It has no steering committee. It's not like Ethereum with a 10-year roadmap put out by the founder, Vitalik Buterin. Okay? So there's a big difference here, and I believe that the regulations are coming. Every agency said so. I believe it's going to shut down the amount of VC capital coming into the space, all the advertising. It's going to have to go the traditional route. Yes, we'll still be building on it. Yes, it's not going away. Yes, innovation will still happen. It just won't be the mania that we saw in the past. But of course, I don't have a crystal ball. I could be wrong. I'd love to hear what you have to say about that. Tell me in the comments down below, but don't just say I'm an idiot. Break down why. Tell me what facts I got wrong. I'd love to hear it. Of course, as always, give me a thumbs up if you liked the video. Hit that subscribe button if you're not already subscribed. And that's what I got. To your success. I'm out.